Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, instead of doing a normal podcast interview with a special guest, Mo Dawoud and I just want to have a general market discussion. We want to talk about what we see in the different markets, in the general macroeconomic situation, on global politics, et cetera, et cetera. So, Mo, first, what are you seeing in all the markets? I think there's a common theme here among a lot of the different markets.
Well, if you look at the chart, it's pretty much consolidating right now. It hasn't, the market, like the Dow Jones, hasn't broke into, well, actually it did recently. But in general, the market has consolidated. It hasn't gone on an uptrend. I mean, we had a little dip at the beginning of 2014, but that was short-lived, and it bounced right back up. But what we're seeing is, low volatility, consolidation. There's not much movement going on in the stock market.
Yeah, and there's not really a catalyst because the Fed is supposedly, and I say supposedly because you interviewed Fabian Calvo and his contacts. We're gonna probably release that interview before we post this one. And his contact said, well, the Fed's still pumping plenty of money, and they're just not doing it overtly the way they did in the QE. Now the money's coming in the back door some other way. Some type of backdoor way. So the money still seems to be coming into the system. There's enormous amounts of flight capital leaving China. We have a lot of evidence in that in the real estate market and other types real estate market in the United States, real estate market in Canada, real estate market in Europe and London. Real estate prices in all these markets are screaming in the major metro cities. And what I would say, Mo, I don't know if you agree with this, the markets seem very fragile to me. You talked about volatility. And Nassim Taleb has this book out. I didn't read it yet, but I've heard him lecture on this book over on Econ Talk. And he was like, for long term, for whether it's a muscle or something or a body part or a human, they have to be tested. They have to have some type of a certain amount of stress is healthy. It builds muscle, it builds stamina. And we just don't have that. It seems the markets are not being allowed, Mo, to have normal free market forces to weed out the bad stuff, to adjust and adapt and correct and recalibrate, and all those types of adjectives that I could throw in there. And it just seems that that's not being allowed because the market has decided, we can't have volatility because all the Wall Street banks are speculating still. They're massively leveraged. And if the real estate market drops 10% or 20%, the bond market drops, 10% or 20%. Like we had that scare, where the 10-year went above 3% briefly, and there were secret bank meetings with Obama and Treasury Secretary and God knows who else. It just seems that no one's going to allow any of this type of things in really any market, Mo, except for maybe commodities.
And don't forget the midterm election is coming up, and I think the last thing the politicians want is a big market crash or a significant correction in the market, because that will affect the polls.
That's a very good point, Mo. And you would think you mentioned that the market's going higher, but they're supposedly taking money out with the taper, right? So there shouldn't be catalysts then to move the market higher. And then we look at the fundamentals of the underlying companies, right? And we have, it's very clear, you look at the very large Dow companies, the very large S&P companies, these guys are not growing that top line. They're not, most of them are not even growing at 5% per year, which is pathetic. They're not, some of them are not even growing at 2%. Some of them, like IBM, are not really growing at all. They're manufacturing, financially engineering these larger earnings through share buybacks and leverage buyouts with all of this cheap debt. And if the economy were really healthy, Mo, if we were really recovering, wouldn't we have real revenue growth? Wouldn't we be spending all of this money on research and development, CapEx, and these things? And it looks to me like when these companies do that, when they spend money on research and development and CapEx, they get punished. So a lot of the large companies aren't doing that. They either plan on doing an acquisition or they just buy back their shares and increase the dividend instead because of the way these guys' payment structures are tied to just beating earnings every single quarter, and so they can get rich quick and then get out, even though probably long-term the company is going to be in much worse shape.
And even the earnings are manipulated by the companies and by Wall Street. So before earnings will come out, they revise their earning guidance, and people think they had a great earning when they really didn't. So we're seeing a lot of that, and I think that David Einhorn wrote that in one of his newsletters back in the fall.
That's a great point. And there was one company, I think Alcoa, and I'm sure we can name plenty more, where Alcoa had their earnings, I think, about 60 or 70% higher. And 2 or 3 weeks before they were supposed to announce Mo, they had conference calls with all the analysts, and there was downward revisions, right? And they lowered them, like I said, an enormous amount, and then they beat by a penny, and then the stock's up, and it's just, and these other investors, the value investors, not the trend traders, the people, everything's priced into the market, efficient market, everything's priced into the chart, right? Those people don't really care that much, or the computer programs that are the algorithms, they don't care that the earnings were revised downwards, but the value investors, right, the people who expect earnings, who do their own math, expect earnings like so-and-so, and see the downward revision, and the stock price go higher anyway, maybe they're short Alcoa, right, and then the earnings get down, revised downwards, and then they're like, well, what the hell just happened?
Yeah, and that's a great point. And also, I wanted to point out that if you look at a lot of companies right now, their fundamentals, except maybe the technology industry, because there's a lot of free market there, so a lot of innovation and research and development going on there at least. But if you look at the oil companies or the other, consumer staple companies, they're not doing very well. All they're trying to do is weather the storm that they've been in since 2008 and just trying to stay afloat.
Well, let's separate the oil companies there, because the shale oil companies are doing really good. We have the shale boom here in the U.S., but the larger companies, the ExxonMobils, and the ones outside of the U.S. are not doing so good because their CapEx is rising so fast, and their oil is not as easy to find and produce as the shale oil is. The shale oil is higher cost, but it's easier to find and easier to produce than some of the other oil, especially like deep water. So it's a dichotomy there, to the point where the oil industry in general. Chris Martinson, for our listeners out there, Chris Martinson wrote a piece for Casey Research and on his own blog, where basically the large cap oil companies like ExxonMobil and Chevron, they don't have the money to increase their dividends and increase their CapEx. So in order to keep the stock price high and keep shareholders happy, and also so the executives can trigger their stock options, they've drastically, across the board, cut back on their CapEx, which means the oil price is going to have to start gradually going higher for them to even consider investing money into finding more oil.
And a big oil company, they have to spend so much money on CapEx just to increase their reserve or find new oil wells. And I think you pointed out last year that annually the companies have to spend $500 billion.
It's more. It's $620 billion. Barclays did the study, Mo, and it's $620 billion just in 2013. And everyone's expecting more than a 10% increase perpetually every single year going forward. So they're expecting over $700 billion in 2014 on CapEx. So that's the national oil companies, the large guys like ExxonMobil, and just to tread water, Mo, just to keep production basically flat globally. Now, really the only increase globally, Mo, in the oil supply in terms of production has been in the U.S. in the shale boom. If you look at all the other major countries that have been producing oil, there's all been significant drop-offs in basically across the board. Even the Saudis don't have much spare capacity. The Saudis are drilling offshore, fracking. The Saudis do not have cheap and easy oil, that much of it left. So basically the shale oil boom has managed to keep global oil production about flat, maybe slightly increase it, but the rest of the world is not the same case. The U.S. is in much better shape going forward because we have the entrepreneurship, like you said, in the oil space. We have the oil well and services company, the drillers. We still have some entrepreneurship here in this country in technology and oil, and that's I think personally, the shale oil boom has completely prevented the collapse from happening already. If we would not have had the shale oil boom, I think the U.S. would have already hyperinflated and collapsed because the oil imports would have just exploded. The trade deficits would have exploded even further, and that would have been endgame already.
Yeah, and we probably would have like $6 gas too.
And yeah, exactly. and the economy would have collapsed under its own weight even more than it did in 2007, 2008, when the oil price spiked to $147 a barrel, and then the gas price, I think the gas price went to $4.50, almost $5 at one point in many areas all over the country. Now, obviously, if you live in California or Chicago, high tax areas, you're probably paying that already, and I'm sorry to hear that, but most of the country doesn't pay those prices right now. But unfortunately, we may see that in the future. Now, Mo, we wanted to talk about what other topics did you want to cover so we stay on point here?
Well, we pretty much hit the general market. We covered that pretty well. And if you're looking at the chart for the market, right now it's pretty oversold, but doesn't mean it's going to crash. I mean, we're in an area where we're at a tipping point in the market right now where anything could happen and it could have a big correction in the market. When it's going to happen, I don't know. What event's going to trigger it or what catalyst? Not sure, because there's many potential black swan events out there that could,
Exactly, Mo. And a crash would violate all the time and energy and money the Federal Reserve and other Keynesian global central bankers have spent on this wealth effect. So we may have a temporary crash, right, where we could have another 10, 20% right off the top. But do you think Janet Yellen's going to allow the real estate market, the bond market, the stock market, do you think she's going to allow these asset prices to stay low for a certain amount of time without massively coming in here again and trying to affect things, with Keynesian animal spirits, because God knows the Keynesians love animal spirits and believe in animal spirits. And it's just really funny. And to add a point to that, Mo, very quickly, I was actually speaking with a friend. I won't name his name, but he's very good friends with David Einhorn. And just so I can add some color, David Einhorn had dinner with Ben Bernanke recently, and CNBC didn't report this because David Einhorn's a very succinct person when he goes on those shows, and he's a poker player. He does not like talking in depth about things, but I asked my friend more about the conversation David Einhorn had with Bernanke, and he probably had to put over $200,000 in Bernanke's pocket just for dinner, which is ridiculous, by the way. But basically what was said, Mo, is David Einhorn asked Ben Bernanke if Wall Street has completely captured the Fed, and if Wall Street controls the Fed to the point where the Fed will throw a taper tantrum. I mean, not the Fed. Wall Street will throw a taper tantrum. The markets will throw a taper tantrum if any more money is taken out, if markets drop, and the shorts will come in, and in Wall Street, the Fed will have to come in like that parent whose child is crying and give them a lollipop, right? Appease them, spoil them, and give them more and more money. So, and Bernanke supposedly got really upset, pissed off, and started cussing out and getting upset over things when Einhorn asked him that.
Well, I could have told him the answer to that. Of course I will.
Well,
the Federal Reserve is made up mostly of Wall Street bankers.
Well,
especially bought the board at the Federal Reserve.
You mean the banks who manage things? Well, most of the people who run the Fed, though, are the academics, the day-to-day people. It's the Keynesian academics who only know Keynesian economics. And, I guess they think that the Wall Street hasn't captured them. I think they think they're above Wall Street and that they're maybe even better than the government, or they're doing the good things of the government. They're doing the things that the Congress can't, maybe. I really think Janet Yellen believes that she thinks that she can do good by lowering the value of the dollar, that'll help unemployment, and all these other beneficial things that she's learned in her Paul Samuelson textbook.
Yep, even Keynes believed that. So that's why they're all doing that. I just recently finished reading a book about John Maynard Keynes, and one of the big things about him that he always changes his position on certain things. So one year he'll say this, the next year he'll flip-flop and change his theory without any empirical evidence or any proof that this theory will work, and somehow people believe him. I give him credit. He was a good speaker.
He was a good politician.
He could kill anybody in the debate, apparently.
Yeah, he could walk in hungover and just kill people. He was very book smart. I personally think he was evil. I listened to a Murray Rothbard lecture on Keynes about all the bad things, and Murray called him a hedonist and a total flip-flopper. And just talking about Keynes's opinions on communism, one day Mo Keynes would say he loves communism and that he wants.
Oh, yeah. I'm sorry, go ahead.
Yeah, one day Keynes would say he loves communism, and the next day he would say, oh, they went too far. Marx went too far. I don't want to murder everyone. I don't want to take everyone's things away with a gun because I still want some money for myself. And because Marx didn't like kind of the bourgeoisie, and Keynes was kind of a bourgeoisie intelligentsia because Keynes came from some money. He was privileged.
Yeah, and also, I mean, he praised Stalin and Mussolini to what they did to their own economy as well. So, I mean, this is the guy that, the politicians today, and they're following his theories and his ideas, and this guy was admiring what Stalin, what Mussolini was doing in their own country. So,
and this was a guy, Mo, who supposedly wrote a book review over one of von Mises's books, but he never even read the book. So, and people listen to him, and because of his dad and his title and his privilege, he got put in a Treasury Department job, I believe, during what was it, World War I? It was World War I. He was put in a cozy job that he didn't have any credentials for. So he was managing a lot of government resources and making decisions they had no experience or whatever for. I cannot believe so many smart people on Wall Street, in the government, etc., who should have some common sense, follow this guy's words so closely. And the people who say, oh, Keynes would never have gone for any of this stuff now, oh, Keynes would have counter-cyclic policy, that they would have done the stimulus, and then when things recovered, he would have started taxing everything back. Because Keynes, at the end of the general theory, he wrote how he wants to kill the rentier class, he wants to crush it. So those are the old people who have worked hard, done the right thing, saved their money. They're too old to work a full-time job. They have capital. Those are the people who want to be rental property owners, who want to live off dividend stocks, those type of people, Mo. Keynes said those people, since they're not working and earning a salary and paycheck like a proletariat and contributing to society, they should be crushed and destroyed. They're not for society anymore. So,
and also, he hated people that saved their money, because then they're hoarding the money, and yet this guy was saving and investing his own money, so he was a hypocrite.
Oh, yeah, he was a complete and total hypocrite, exactly, and a flip-flopper and a lot of other things. People should really look into Keynes before they trust him, but I think that's why a lot of people who quote Keynes, they don't look into Keynes, and I think that's the way that they want the financial media and the people in academia. They don't want you looking into Keynes like the Austrian school does. Which, I mean, if you spend a couple hours looking into Keynes's life and all the different crazy things he said, I wouldn't trust what he said. Let's just put it that way. Okay, so let's talk about central planning. A country that's using central planning, China. Since we talked about Keynesian economics, let's talk about one country that might even be using the Keynesian central planning model even crazier than the U.S. and Europe. So we have China here, Mo. Now, earlier at the beginning of the year, in some of our predictions, some of our predictions have been right. Some of our predictions have been wrong so far. One of the things we got right was the crash in copper. Copper at the beginning of the year was around $3.50 a pound, right? And we are seeing all these stories come out of China, and they were more negative and more negative, and the copper price is staying high. And I was saying there's no way the copper price is going to stay this high. The demand is not real. Even though China is probably moving some of its surplus money into copper still, there's just no way that they can prop up the copper price 100% all by themselves, because no one else is buying it, and China is even slowing down. So they're even going to buy less. And we had a huge drop-off in the copper price. Do you expect copper to go lower? And what do you think China's going to have to do? Are they going to have to do bailouts, or are we going to have a potential collapse of the government in China?
Well, I think the price of copper is going to stabilize from here. I don't think it's going to go higher because there's no demand for it, because like any other base metal, except for zinc, because there's a supply shortage with that metal. Like copper and other base metal, they're attached to economies. The economy's not doing well, the base metal is not going to do very well. So I don't see any catalyst for them to go up. I think it would stabilize from here. And then you talked about if the companies in China are going to need bailout. It depends what industry you're talking about. I talked to Dan Collins and I interviewed him last week. And there's a certain sector in that country that's over-leveraged and may need to be bailed out. One of them is the steel companies in China, if you compare the steel companies in China to the one in the U.S., they are much more efficient in China. Cause they can produce more steel in 6 weeks than what the U.S. can do, because in the U.S. they got, like the auto industry, they have a big union problem, so they can't create steel more efficiently. And what is it they use steel for? They use steel to make cars, and they use it to make military tanks and chips and missiles and etc. So that's very important.
Yeah, China has a lot of defense spending increases. For our listeners out there, besides the U.S., the real explosion in defense spending is coming from, surprise, surprise, China and Russia. So China and Russia, the last, 8 years, have been massively increasing their defense spending, whereas the U.S. has been increasing at a decreasing rate. But those are really the three big spenders in the defense arena. And I think I would agree with you about the steel companies. Now, I don't know how levered, if they've hypothecated and rehypothecated, how bad their balance sheet. I haven't looked at those. I don't think they're good long-term investments. But I don't know about the copper price, Mo. I think the copper price may still be a little too high. We may just agree to disagree. I think we may see $2.50 briefly. We haven't had a big spike down in copper. We may have a scare because we've had a lot of people still bringing on new copper mines. There's still a lot of supply coming online because there's still some companies that are committed to investing in copper projects. We may have $2.50 copper in the next 2 years, and then we drop, and then we start climbing higher again, maybe to a trading range for a long time, maybe between like $2.50 and $3. That would be my best guess as of right now. Maybe my opinion will change based on the facts, but I think your analysis there that there's just no real demand. But I think what I see differently than you is that there's still a lot of copper producers bringing on supply. So I think we could come down that there's a lot of copper producers that are bringing on supply and hedging, but those hedges are not going to last for forever. So
I agree. Yeah, I agree. Still a lot of copper mines out there still producing. For some unknown reason.
We do not like copper as a long-term investment. If you have to have copper in your mining portfolio, maybe then it's a primary silver deposit with some copper credits or something like that. I don't like it. Now, if copper were to drop to $2.50, maybe below the cost of production for a good amount of the mines, for a lot of marginal cost producers, maybe say like 50% of the copper producers could not produce copper at $2.50, and the copper price stayed down there, like with what happened in coal, it would be an interesting speculation. We have that in other commodities where I think there's a lot more demand growth still for, especially in the food sector. The soft commodities have been some of the best performers this year. But before we talk about commodities, let's just talk more about China, Mo. So Jim Rickards, he said that he thinks China is going to have to bail out a lot of their industries. He thinks they're going to have to bail out their municipalities. He thinks they're going to have to bail out all their banks because their banks are not free markets in a lot of cases. The banks were, I think more than 70% of Chinese banks are controlled by the government, and they are directed to give out loans. So whether they want to or not, they have to give out loans, or they risk, political shaming, their families being excommunicated out of the Communist Party, or, even worse in China, which is execution or imprisonment or something else. And I think that's why, Mo, you've seen a lot of Chinese people, businessmen and other stuff, and also government officials, that they've been hedging their bets. So they've been slow. They've been actually not slowly. They've been quickly. I would really say since 2009. It was happening slower than that before because Gordon Chang and Dan Collins had talked about this to slow amounts. But really since the last China stimulus after 2008 crash, a lot of Chinese knew that it was artificial, and that's why the money's not going into their stock market, because they don't trust the accounting there, but also because the Chinese people know that a lot of the stuff there is artificial growth, and they know that it could all come potentially crashing down economically, and that's why they've been taking the money out and buying. Some of them have been, taking whole suitcases to the United States or Canada of cash, and they've been smuggling across the border and just paying all cash for a house and, no mortgage, and then just getting right back on a plane and going to China.
Yeah, and Dan Collins, we talked about that as well, about why China is going to other countries to buy hard assets, especially real estate. They've been a big player in real estate in this country in the past year or so. They overtook Russia as the number one buyer in New York real estate. And he told me that there's a lot of Chinese investors are looking to diversify outside of China. So that tells me that they're trying to minimize the risks of having all their assets in China. Because maybe they think there's a crash coming in China or a big correction. So it's interesting to see that they're coming over here and investing in companies and real estate here in the U.S.
And the thing is, if we do have a crash in China, our listeners should have their eyes open for potential good Chinese profitable companies like maybe Baidu or Alibaba after it goes IPO. But you really got to wait for that crash to come, and then you got to be very careful with the accounting stuff.
Yeah, you got to be very careful. A lot of red flags out there.
Yeah, as bad as the accounting is for some U.S. companies, the Chinese ones are even trickier, and I think that's why a lot of Chinese people won't buy stocks on a Chinese exchange, because they're just so scared of the accounting. Maybe paying a dividend would mitigate some of these risks, but as of right now, I'm not interested in any Chinese stocks on the long side. I still think the best way over the long term right now, at least to play China, is from investing in oil and natural gas and smarter energy plays of companies that are profitable, and then also food. Because I think pretty much China in general has on a purchasing power parity basis, they have a rising middle class, and they're going to eat more calories, they're eating more protein. If you read Ned Schmidt's newsletter, he talks a lot about how milk demand in China, demand for milk and eggs and chicken, has just exploded. And you wouldn't necessarily, I'm not sure if the Chinese Mo eat a lot of dairy. Maybe they're eating ice cream now. I didn't know they eat a lot of dairy, but it sounds like that's a rapidly growing industry in China.
And yeah, and food and agriculture, it's always a big demand no matter where you live and what country you live in. So investing in agriculture and fertilizer like potash would always be a good investment, no matter how bad the economy is.
Yeah, I really like potash long term. I think the sector has been beat up a lot. I could pull up POT here. Give me a second. I'll pull up POT's chart and earnings, and we'll see if it's still at a 52-week. Yeah, I mean the stock's come up off the 52-week low. I thought the stock, when it was around 28 last year, I thought it was a really nice buy. People are going to have to be patient for a little while. But, I mean, the company is still profitable. It's still the top company in the potash space. Its dividend yield is actually not bad, Mo. It's almost 4%. So you're getting paid a 4% dividend yield to wait. I mean, that's, for a potash company with long-term potash contracts, that's pretty good. It's definitely safer than a bond, right?
I think almost anything is better than a bond, except for bank stocks.
Or holding a humongous amount of cash, maybe euros in a European bank.
Yeah, exactly.
Yeah, I mean, well, obviously people should have cash just in case there is a market crash. They should have a certain percentage of cash, and we've interviewed people in the past about how much cash they should have as a hedge. But you don't want to be in 80% cash or of your total net worth. You don't want to be holding that much cash for 5, 6, 7 years. You want to maybe hold the cash for a year or two, find a plan, whether that's buying a couple rental properties with Kathy Fetke through her Real Wealth Network, or Jason Hartman, who also could help you find Tier 2 rental properties in the United States. You can find some cash flow there.
Fabian Calvo, too.
Yeah. You can maybe make about $1,000 a month for a house, and you're only putting, $10,000 to $40,000 down per house. And these are not large houses, but they cash flow pretty well. Their rent-to-value ratio is good. That's a good idea. The dividend stocks right now, Mo, there's some special situations once in a while where you have a company just totally bomb earnings. But in general, I don't think there's a lot of value in the general stock market right now. In technology, though, and commodities, I think, are the best values to me. Technology, not only certain sectors. So let me just give you an example really quick of stocks that have come down. I looked at a couple before here, and I've looked at these, but I wanted to pull out the financial information for our listeners. One of these companies is Intuitive Surgical. That's on the NASDAQ. It's symbol ISRG. That stock is around a 52-week low. It was over $500 at one point. That stock is now down to around its 52-week low at $365 a share, give or take. Company is profitable, does not have a dividend, but is rapidly growing. And it's in a real fundamental bull market. There's a lot of problems with surgeons and being able to get in there and do proper surgeries without doing a lot of damage to the rest of a patient's organs. And I think this is clearly the future of way medicine's going, especially operations. So this company is only trading right now at around 24 times forward earnings. So next year's earnings are expected to increase, and it's only trading around 24 times. The other technology stock I really like, and I think it's close to a buy range, maybe it goes a little lower, is 3D Systems, Triple D. That stock is, again, around a 52-week low. That stock's been cut in half. The trend traders no longer like it. A lot of people on Wall Street hate it. Jim Cramer hates it, which is probably a good sign.
Yeah.
Jim Cramer hates it, so it's probably a good sign. It's probably a good contrarian indicator that the stock is going to be close to bottoming. They are the only company in the 3D printing area that is profitable, Mo. And their earnings, their forward earnings, because their current earnings are actually small. They are earning money right now, but they're trading right now at a very high current PE, but their earnings are expected to grow so much because they've been doing so many acquisitions of profitable companies that are not listed on exchange. So they've been buying private companies not on exchange. They've been investing money in research and development. You know, what really is required to fuel real growth, because real growth is fueled with taking risks with your capital, research and development, CapEx, those types of things. That's how a company really grows. It's not through financial engineering like a lot of these other companies are doing with buying back shares. And Triple D, next year's forward PE ratio is only around 40 times earnings. So that's not bad. Now, it's not that bad. Now, if I could get it for 20 times earnings or lower, that would be great. For a really good growth stock, for a stock you know that over the next 5 or 10 years is probably going to grow earnings almost every single year. But the odds, we talked about this before we went on, and the odds of getting a company like Apple at $90 a share back in 2008, 2009.
I remember that.
You have to have cash on the sidelines. You have to be greedy when others are fearful, and you just have to have some luck on your side, because the odds of a really bad market crash and things prolonged for that while, especially with all the intervention of the Fed, and being able to come in and buy a really quality growth company, a company you know is going to be able to grow earnings for the next 5, 10, 15 years and be a leader in their industry like an Intuitive Surgical or a 3D Systems, it's going to be let me put it this way, Mo. I think it's going to be very tough for people who think that they're going to be able to get those companies at 10 times earnings. Maybe we have a month or two period where we have that, but I just don't think that the odds of that likely. So maybe people can stick a toe in at these levels and buy a partial position here and maybe keep some cash just in case. But if you're planning on buying, like loading up the bus just at that price, I wouldn't bet on it.
Right. Well, you never know. I mean, stock market, like we said earlier, that a tipping point. So we could see I don't say a crash, but, a 20% correction. So maybe by then, I mean, it won't be 10 times earning, but, it could be a lot lower. So we'll see. So before we shift gears here and talk about current events, is there any other topic we should discuss?
Sure. Let's talk about GM first. I wanted to talk about GM, and then.
So you want to talk about current events now?
Okay. Let's wait to GM then. Okay.
Okay.
Let me just briefly touch on commodities and any interesting plays I see. I think with natural gas, the producers have not the producer stocks. We have like Devon Energy, Chesapeake Energy. Some of those types. Those stocks have already gone up a decent amount. I think the best way long-term to play natural gas is going to be the creative entrepreneur who figures out how to use that cheap gas, either transport it through LNG to other countries at a much higher price, and they already have long-term contracts. So Cheniere Energy, which is a stock we picked out at $6 a share back in 2009, and I told people to buy it and hold it. I really liked their business model back then. And yes, they weren't profitable back then, and they're still building things out, but it was a speculative stock, and it was a home run. It went to over $40 a share at one point. I don't know what it is right now. But looking for the next Cheniere, I think one of the best ways is we have all this cheap natural gas, Mo. Diesel prices are high. gas prices in the U.S., they're not as high as they were in 2008, but they're probably going to creep a little higher each year because the shale oil producers, it's going to be a little tougher to produce more shale. Costs are going to go up a little bit each year. I think Westport Innovations is very interesting at this point. The company's not profitable yet, but it's a technology company, and they have all the key patents to produce compressed natural gas engines and put those into cars. So they have contracts with Ford and those guys, and they're not profitable yet because management has not been as efficient as they should, but they're close. And the stock's near a 52-week low. So the stock at one point last year was at $35, Mo, and now it's down to only 15 and change. So that's an interesting bargain play that over the long term, that's on the NASDAQ. It's symbol W as in William, P as in Pringle, R as in Rachel, T as in Tom. That's an interesting play. I really like the plays, like I said, for natural gas where it's either you're locking in long-term LNG contracts to transport it, or you're building a new natural gas pipeline from a large shale play to a higher cost there to a refiner, so the refiner can make money and export the gas, or to a chemical plant, or natural gas storage, or a creative entrepreneur. Because one of the things, Mo, why the natural gas spiked this year, in the last this cold winter, was because there wasn't enough storage capacity. So I think
and the brutal winter too.
Well, there was the brutal winter, Mo, but we also didn't have enough natural gas storage capacity. So the two factors combined created not enough supply in the near term, and demand increases. And there were some people paying enormous natural gas prices. And the utilities can't really use coal anymore, a lot of them, because of the Obama administration and the EPA. Basically, all the world leader, the energy markets are not free markets. They're government controlled, basically, and there's some entrepreneurship and stuff allowed in there, but not a lot. So basically, the world powers, all the globalists, the economic and political elites of the world have decided that they're going to start slowly phasing out coal. Almost ever, including China, and a lot of the power plants that were using coal are almost all going to switch to natural gas. Maybe they'll switch back to coal temporarily, but long-term, the trend is they all want to lock in permanent natural gas supply and contracts. So if you as an investor recognize a trend like this, where the natural gas price has bottomed and it's probably going to slowly stair-step higher, maybe except for the spike that we just had, I don't know if we're going to see spikes like that in the future. But I think the picks and shovels plays, the technology entrepreneurs in natural gas that can figure out how to replace more expensive diesel or oil with other natural gas things like the Pickens plans plays, those are going to be good investments over the long term.
Yep, I agree. Pretty much any pick and shovel play for other type of commodity as well would do well, especially in the oil sector. The pick and shovel companies, they're the ones that are very profitable.
Oh, yeah.
Yep.
Oh, yeah. So many of those guys, Mo, have so much order books. So we're talking about Halliburton, Schlumberger, Baker Hughes, forgot the Weatherford. Even Weatherford turned around. That was one that was down a lot. And you have FMC Technologies. These guys have order books for many years. So they're going to be doing drilling and fracking and oil services outside the United States for many, many years to come. There's not that many industries, Mo, because the capex for oil is so high, just to maintain the global production levels. So those are contracts that are going to go onto the drillers and the oil service companies. It's going to go right into their pockets as cash. So where there's a lot of capex being spent, those companies can make a lot of money, especially if it's a necessity like natural gas to heat your home or air conditioning. Natural gas is also used in air conditioning and also to heat to cool the ice quickly. For ice hockey, I didn't know that. I just learned that.
Oh, I didn't know that either. That's very interesting. So, on our last segment of this podcast is to discuss current events in this past couple months. And one of the big ones was GM, Government Motors, or General Motors, either one. They're the same. And recently, there's a big recall with the GM cars, especially the Dodge and the Pontiacs, and a lot of them had an ignition problem that when you start the car, they caught on fire, and I believe people got killed from that as well. And there's a lot of information and data indicating that the government knew about that in advance, and even stole the stock before it was released to public. So let's talk about that and the implication and why that happened.
Well, this is just cronyism mode. This is just big government and a inefficient, corrupt, bureaucratic business. GM was incredibly inefficiently run. The Japanese just beat them at their own game. The Japanese invented the just-in-time supply chain, and they basically crippled GM and Ford and Chrysler is the other one, right? Chrysler, yeah. Yeah, that's the other U.S. auto company. They just crippled them over a number of decades. I remember when my dad was, when I was little, and my dad bought an SUV for the first time. He bought a Toyota, and Toyotas were still, this was like late 80s, early 90s. Toyotas were still not viewed as popular cars. Earlier, from what I've heard, in the 70s, when Toyotas first came over to the United States, they couldn't give those away. That's how, like, people loved American cars, Mo. But the Toyotas, they gave them away at a cheaper price, and they gained market share, and the quality improved drastically. The Japanese originally just started off knocking off cheaper versions that were cutting corners and stuff, which is essentially what the Chinese are doing now. But the Japanese soon provided value added. They gained market share. They started innovating. And now, Mo, the perception of a Toyota is a lot different than it was in the 1970s. A Toyota car in general, now obviously there's some fallback, is known as a quality car. But back to GM. I mean, GM is just a disaster. And it's a combination of factors. So you have the United Auto Workers who gave their workers too high a salary, and the corporation was paying not just for the workers themselves, all their health benefits and stuff, but they were also paying most or all of the benefits for all their families. The salaries were way above global salaries for other auto workers in other countries, and in a global marketplace, that's very tough. And then you have the people, the CEOs at the top, who were hiring all their friends and family members and third cousins. They were making them junior vice presidents and stuff and giving them six-figure salaries. And they were just fat and happy, living off their old reputation. And we've seen this. One misperception, Mo, about the auto industry is that it's like a consumer staple. And it's like some people think it's a consumer staple, but if you're a value investor and you look it over, it's actually a very capital-intensive cyclical business. It's very consumer discretionary. When these auto companies, Mo, retool a factory, they're spending billions of dollars to put in new robotics and new equipment. They're paying their workers very high salaries off the top. Their input costs are high. This business, in a lot of cases, is even worse than a mining company.
Oh yeah, definitely. I mean, it's not the auto worker. They're almost the same as a federal employee that get all the perks and benefits, and it's hard to fire them. They got a big union behind them, so not much difference between those two.
But anyway, though, Mo, with the cronyism that happened, it's just amazing that you had the government, I think, towards the end of last year, like January maybe, dump a lot of the shares that it owned because, we made a profit on them, right? Yeah, right. We made a profit on them. We're not going to count any other off-sheet balance liabilities or how the United Auto Workers are getting preferred shares or anything else. Government says, we did a profit, so that means we can do more ballots in the future. Look at us, we did a great job, right? And then you see the news come out only a couple months later about all these recalls. I'm thinking I'm thinking the government definitely knew the recalls. Now, are we ever going to find any proof that the government for sure knew? I don't know, because the government's not going to police itself. I don't think we're going to have hearings where the private citizen is going to get to do this and this and this, because I don't think the government's going to police itself. I don't think Congress is going to call up other congressmen on the involved in the bailout panel and the government agency people. Who knows if the government agency people even tell the truth? I mean, there's so many documented cases now, Mo, of government bureaucrats lying under oath now in front of Congress, right?
Yeah.
And it's not just with the NSA. It's with so many other government agents, so many others. And it's just becoming ridiculous, though. We have crony capitalism. We have big corporations and big governments, and then the unions are another special interest group, and they're all teaming up to screw us. And then GM is fundamentally, it's not as good a company as it would appear. Now, they had good numbers, but they did a humongous amount of channel stuffing last year. Porter Stansberry talks about this. almost all of their sales growth, Mo, for their car loans here in the U.S., now maybe it's not this way in the rest of the world for their global sales, but most of their U.S. growth came from subprime auto loans. And these are people who put little or no money down, and they got these really long-term auto loans. They can barely pay the interest payments. I mean, if you don't put a lot of money down, you don't really own the car.
Yeah, and I see a lot of commercials out there where they're doing special deals, 0% down, 0% interest for, people with great credit.
Oh, yeah.
For, 4 or 5 years loans, etc.
I don't know about you, Mo, but they're sending my dad these things that they'll give him a trade-in. Most of them are from GM companies, way above the market value for his car, as long as he takes one of the cars off the dealership. So they'll give him like better terms and all these other things. It looks to me, Mo, that GM, like I said, did channel. For listeners out there who don't know what channel stuffing is, it's basically like booking an order, but you just dumped it on someone else in your supply chain. So the way the auto business works is GM manufactures cars, but they also own a part, or they have an agreement with their dealers or distributors, right? And their distributors have to buy a certain number of cars per year, and GM looks like they forced more than the normal amount of cars. The car dealer said, "Oh, we can't sell these many cars," and GM forced them to buy them anyway. And that's what it looks like. So GM could say, "Oh, we had great sales in the U.S., and the dealers, meanwhile, Mo, are stuck with all this excess inventory that either they have to give away for free with some of these ads that you mentioned, either subprime or crazy interest in financing that no one in their right mind would normally offer, or they're going to be stuck with the cars, and they're going to have to write them off or risk going bankrupt."
And one of the other things I find about the big government protecting the auto industry is the way they've been treating Tesla Motors. Now, if you want to buy a Tesla car, they don't sell it at a dealership. You got to buy it directly from Tesla. And they have independent stores. They have one here in Virginia in a mall if you want to buy a Tesla car, and D.C. as well. But if you go to New Jersey and I think Texas, they're banning Tesla from selling directly to consumer. They want them to sell it to dealership, and the reason they're doing that is because a lot of the lobbyists are making an argument that the business model for Tesla is hurting their business.
But in a free market mode, we want the cost to drop. And if Tesla doesn't have to have all these cars as inventory in the dealership, right? They only have one car to test drive and one car in a small showroom. I've walked by the Tesla showroom here in the DC area. It's in DC. There's one or two cars inside the showroom. It's a small corner retail space, and maybe they have one car you can test drive, and that's it. So they're not holding in this massive. If that's what the free market demands, and we have to close all these retail spaces, I think it's a good idea if it's going to save consumers money. But the people who are in power, the bureaucrats and the politicians, they're going to take money from other people's pockets who don't want a free market, and they're going to try to stop competition.
Yep, and I agree.
And this stuff is also happening, too, with Uber, which is the new taxi service. You have all the taxi unions, the people who paid $1 million or more for a taxi license in New York City, a medallion, I believe it's called. People pay that a humongous sum of money for a medallion in New York City, and those people are suing Uber. They don't want it in New York City. They're suing, I think, in other cities and states. And then you have this new Airbnb, which is the online booking site where people can rent out their own homes or condos or apartments. If they're going out of town, they can rent out one room or the whole thing. And you have the hotel suing these guys for that, too, to stop the free market.
And yeah, that's just a trend we're seeing right now. A lot of people are demanding government to protect their business, mainly the big businesses, to protect their profit because the economy is in a tough state right now, and the big business are doing anything they can to protect their bottom line and their perks and their benefits.
I would agree, Mo, and the revenue numbers would indicate the top line, but let me give a couple very quick sobering statistics, and then we'll talk about the last current event, which is Belgium, and then we'll give a wrap-up then on asset allocation strategies for what we see in the markets going forward. Okay.
Right.
Remind me of what I just said. Okay, so what did I say before Belgium?
You wanted to talk about, I forgot too. You want to talk about Belgium asset allocation strategy and
Okay. Okay, so we'll talk about Belgium briefly, and maybe I'll remember the last point I was going to make. In terms of Belgium, the mainstream financial media isn't even talking about this, and this pisses me off so much, Mo. They haven't mentioned it once about the Treasury reports and who's buying them. You would only find this online and in the alternative media. Okay, Belgium bought over $100 billion with a B dollars worth of treasuries. They don't have the money to buy these treasuries. They don't run a trade. They don't run a trade surplus. They don't run a budget surplus. Their GDP, Mo, the amount of treasuries that was bought in only a couple months is over 30% of their GDP. It's an insane amount of money. There's no way they could afford it.
Yeah, they bought $141 billion in treasuries since December, and they're the third biggest buyer of treasury, coming out of nowhere. Just small countries buying all the treasury bonds. For what reason? Or where are they getting the money? We don't know. Maybe it's coming from European Union, and the European Union getting it from the Federal Reserve.
Well,
who knows?
Well, we know the reason, Mo. We know that the Paul Craig Roberts put out an article on this, and Dave Kranzler wrote it to us on Paul Craig Roberts' website. You can go read it. And he said that basically another country, probably Russia, dumped over $100 billion worth of treasuries in a week. So he said that the Fed did not want to increase QE, like publicly announced that they had to, right? Because it would look weak if they, without another meeting and worse economic data, if they had a reverse like that. So it just sounds to me like the money was printed in whatever way, either currency swap, backdoor bailout to European country, or the Fed just printed and handed it to someone, and just gave Belgium the money. And that's that, because they have to keep the interest rates down. They cannot allow free market forces. As we know, if the interest rates go to a certain amount of level, the U.S. won't even be able to pay the interest payments on the debt. And there's any type of recovery that's already in the economy is already very fragile. Okay, I just remembered the other things I wanted to mention briefly, because talking about the regular economy. I just want to give 3 sobering statistics here, and I just read these. Okay, this one, Mo. Okay, if the economy is recovering, how come the last 2, because we just had another graduating class from college, seniors who just graduated in 2014, they graduated in May, these people were polled, a lot of people, and how come 80% of them do not have a job secured? And if they do have a job, it's mostly part-time or unpaid internship.
Yep.
So, and it was the exact same numbers the year before, basically. The numbers are about the same. One of them was 83%, the other one was 80%. So we have 77% of all jobs that have been created using the government's own numbers since 2008, 2009 are part-time jobs. And the last data point I will give you, besides all the others that I just mentioned, is Kerry Lutz mentioned this, and I think he pulled this from Bureau of Labor Statistics data. This is the government's own data, Mo. More than 20% of all households do not even have one person earning a paycheck in the United States.
So we're having a lot of college students that's moving back with their parents. Those are probably the ones that are not getting a paycheck.
And we have Mo, true. And we also have parents that are moving back with, extended family members, grandparents or aunts and uncles, people who have a job and have money. So we're kind of going towards that way of what happened in the 20s and 30s, except there's inflation in your food, your rent, your insurance bill, your cable bill, your consumer staples, and your necessities.
We also have shrinkflation, where your portion at restaurants and grocery stores are shrinking, but they're selling it at the same price.
Yeah, so this is what's really bad about inflation and taxes combined. It's completely and totally destroying the middle class. Now, we can argue whether this is being done intentional. Obviously, I think Marx and Lenin and people who believe in them, this is exactly what they wanted. I don't know if all the people who are in power fully believe in Marx and Lenin, stuff like that or not. It's debatable whether or not they're all Fabian socialists or they're really just good-hearted Keynesians like Janet Yellen, and they mean well, but they just are screwing things up. Because from what I've heard, Mo, Janet Yellen doesn't want to help the banks, but she's going to end up helping them anyway. She wants to help the regular people. So it's really laughable. Now, back to the treasuries. Anything else you want to bring up about Belgium here? So it looks to me, Mo, like someone who had a lot of treasuries in the past. You didn't read the Paul Craig Roberts article, Mo. You should go read it after this interview. But it looks to me like maybe China and or Russia are starting to really accelerate their strategy of doing currency swap deals and oil deals, right? I think we have a big oil deal coming on May 20th. It's either oil or natural gas, where they're going to be China is going to be buying from Russia a large amount of hydrocarbons in either RMB or in a multiple of other currencies, and it's not going to be done in dollars.
Yeah, we're seeing a lot of countries operating outside the petrodollar. We're seeing Russia and Iran doing barter exchanges. We're seeing India and Russia exchanging goods and services using their own currencies. So we're starting to see a trend where a lot of the countries are using their own currencies or hard assets to trade. And that trend will continue as long as the Fed continue to print and devalue their own dollar. And we're also seeing China and Russia decreasing the bond buying as well.
Yeah, and this is amounting to what Jim Ricker said, and our listeners should go read Currency Wars and go read his new book, The Death of Money, and he talks about complexity theory. So what we have here is death by 1,000 cuts to the dollar as the sole world reserve currency and the petrodollar, or do you blame the one snowflake that falls, Mo, or do you blame all the snowflakes that accumulated over it, the straw that breaks the camel's back, or the one snowflake that led to the avalanche? So we haven't had the avalanche yet, but that doesn't mean we're not going to have it in the future. So that ties us into our closing here. I think we should end with asset allocation strategies, and maybe just we don't have to talk about any specific companies or anything. We mentioned a few for our listeners. I think we made it clear about the resource industries that we still like. My views haven't changed on those really long term. Any of the resource industries I like. But any asset allocation ideas, Mo, for our listeners, what should they be diversifying their money into? It obviously should not be probably 100% gold or 100% silver, because we don't know the rules that the governments are going to have going forward.
Right. Well, going forward, if people are just tired of the junior mining, a lot of uncertainty and bad management, I recommend that they buy the physical silver and gold, and then invest in the royalty companies like Sandstorm Gold,
Silver Wheaton,
Franco-Nevada, and all these other good companies that are profitable. They don't have to worry about the operating risk and all the other stuff that comes along building a mine. So if people just want to, just focus on the royalty companies, I mean, you're going to get a good profit out of them. Their leverage is not as big as the junior mining, but you make a decent amount of money if you just focus on the royalty companies. And also, if you want to invest in real estate, that's always a great idea. You just got to be careful what area and how big of an exposure you have in real estate. Because, there's certain areas in this country where there's a bubble going on, especially in D.C. and in California. And a lot of the houses and condos and et cetera are very overvalued, so you don't want to pay too much.
Plus there's not, in most of those areas, Mo, especially in California, because I'm from California, I still have a lot of friends there, there's not job growth, really. Unless you're outside of Silicon Valley, there's not real job growth.
So when you buy real estate, you want to go to an area where the job growth,
yeah.
There's good demographic. So if you want more information about that, I recommend people to go listen to our interview with Cassie Fikes. And also, Fabian Calvo podcast will come out before this recording. We'll talk about real estate in that podcast as well. And also, another sector that we recommend is the technology sector, mainly because technology, we think, is a good hedge against inflation, because these companies devote their time trying to make things efficient and reduce input costs for a lot of the companies out there. So I think they're a great investment. You just got to do your homework and find a good company with a good management and good growth, just like any other company.
Exactly, Mo. And with technology, it's about the right valuation. It's about it's really about the right valuation. Are you buying that technology company that's going to grow for the next 5, 10, 20, 30 years profitably? Are you buying it at 60 times earnings, forward earnings? Are you buying at 40 times forward earnings, 20 times forward earnings, or lower? If you can buy a really quality technology growth company at 20 times earnings, forward earnings, or lower, you're looking at Sir John Templeton. That was one of his strategies. He believed in Buffett and Graham in contrarian and buying stocks on weakness, but he looked for buying growth companies when people hated them. So he would look at forward earnings. I just read a book on John Templeton, studied his life and his investing strategy, and I really like it. I think it was a libertarian too, because he talked about how taxes should be low and how when people save money and invest and the taxes are low, people tend to make a lot of money and make other people happy, and the economy runs efficiently, and you don't have crazy politicians ruining everything really as much. So in terms of the technology sector, I think there's a lot of financial history backing us up, whether it's Walt Disney or the other millionaires from the 1920s and 30s that found all these amazing technologies back then, whether it was radio or television or refrigerators, and eventually led to a nice consumer class, all these great consumer products. Or also in the 1970s, the microchip companies and a lot of technology companies still ended up doing pretty well after the 70s stagflation. So inflation or deflation, technology companies at the right valuation over the long term do very well. The dividend stock companies, Mo, a lot of those are overvalued because a lot of people have moved from risk on. A lot of the trend traders have moved from dumping the technology companies and shorting those into dividend stocks as a safe haven play. I would, at this point, I don't think there's a lot of good bargains for dividend stock plays, large caps, but if they come down, I would. There's some special situations. Once in a while, you can get a really good master limited partnership play on sale, like a pipeline company. One of those that's gone on sale a lot is Boardwalk Pipeline Partners. Stock was around a 52-week low recently. They bombed in earnings, and they lost some contracts, some long-term contracts. But they're in the natural gas storage business, Mo, and I think we talked about earlier in the podcast that the natural gas storage business over the next 3-5 years is going to be a good one because they're going to have a lot of gas, and we're going to need to move it either to ports to sell for LNG, or we're going to be putting it into gas stations then for new cars and trucks and buses and taxis and stuff. So that's an interesting play. I really like small cap companies, but the small cap companies, it's a case-by-case basis. I wouldn't buy them across the board. They got to be a good business model, generate free cash flow, not have bad balance sheets, things like that. And we've talked a lot about the resource sector, so we won't talk about that really too much. But if our listeners, if you have any questions about any of the resource area that you want to talk to us about, just shoot us an email.
Well, how about this? If any of our listeners have any questions, if we get enough questions, we'll do another segment where we'll answer all those questions.
Okay, yep, that sounds good. And we're to just give our listeners an update on what we're planning next couple days or weeks. We're going to be working on an Indiegogo page to raise some capital because we want to start rapidly growing Wall Street for Main Street and maybe devote a paid podcast subscription. So we're going to continue to do 1 or 2 probably free podcasts per week. They're going to be this type of style or where we interview a guest. But we would really like to do it every single day of the week, so Monday, Tuesday, Wednesday, Thursday, Friday, maybe one on the weekend, and also charge for it. But in order to do that and to serve you guys, we have to charge for it. We have to be able to make money and not be able to have to work, jobs we don't like to pay bills. So if you guys are willing to pay, we'll make you the best content. We'll teach you how to invest in all these different asset classes so it can be diversified. And no matter what rules the politicians change, whether there's a 90% tax on gold, physical gold in the U.S. or whatever these crazy and stupid politicians do, we're going to help you through all this.
Yeah, I agree. So we'll be working on the Indiegogo page for the next few days. And also, if people want to submit their questions, they can go to our website, www.wallstreetformainstreet.com, and go to our Contact Us page, and you can submit your question there. Or you can go to our Twitter page and submit your question from there as well. And also, if you like our podcast, go to our iTunes channel and give us a review. We greatly appreciate that as well.
Yeah, that's something I forgot to mention, Mo. That's really important. I think our podcast, we give you guys a lot compared to a lot of the other podcasts out there. Most of the ones that are on par with this podcast, they charge. And we don't right now. So I think we would greatly appreciate some extra reviews on iTunes. We spent over an hour here doing this podcast, and we do a lot of these with quality guests. We open up our contacts list. We're sending out emails all the time looking for the best guests in energy, technology, value investing, resource stocks, many other types of asset classes. We just brought on real estate, Kathy Fecky. We're going to be looking to bring on other real estate guests. And, we greatly appreciate it. Please share our podcast. I think you like it. And thank you very much for your time. Thanks for listening. And have a good week.